Awesome. There it is. Hello, everyone, and welcome to another episode of LunarCrush Live. This morning, we've got Jon from SteadyState.Finance, right? Is that how it goes?
Yep.
And we got Jon LunarCrush, both spelling their names Jon, so super stoked about that. Little technical difficulty this morning. If I randomly disappear off of this show, it's because we have no power and no Wi-Fi. But we're going to do it here off of the phone. Appreciate that. Just a reminder to everyone. We do not take payments for our live stream. We bring on cool, fun people in the industry that have dedicated their lives towards cryptocurrency and, the passion that we have in the space. Keep an eye out. I think we've got Start Atlas on Friday. I think it's Friday. It's going to be our last live stream of the year with Start Atlas. So we're super stoked to have them on. We'll be posting about that towards the rest of the week. But without further ado, Mr. Jon Libby, what's up, my man?
Hey, not much. Things are going good.
Awesome, dude.
Yeah.
We always like to start, where are you in the world and what's it like there?
Currently based in Austin, Texas. It's very cloudy and very rainy, and but it's still, even on the coldest day, it's still 50 degrees. So we're loving it over here. It's awesome.
That's not bad.
Snow in Texas
at all.
Not yet. It's coming, I think. So
well, it's not like that. Was it last year? You guys had that crazy ice storm.
Yeah, so I wasn't around then, but I heard about that. I remember seeing that in the news, and I'll tell you what, if you don't know how to drive in the snow, I'm from Maine originally, actually. So I've learned we drive through nor'easters, storms. It's just another day for us. If you don't know how to drive through this stuff, it can get really brutal. And that's what I hear every time in Tennessee, you'll drop an inch of snow, and for us, we'll go through a foot, and that inch of snow, and there's car wrecks everywhere and trash. And everything blows my mind whenever I see that stuff. But yeah, it's I'm not looking forward to the accidents,
Yeah. Folks in Texas don't, some people don't really know how to drive in the snow down there. I would say that.
Mm-hmm.
I need to get to Maine again. Maine's beautiful, super underrated. The summers in Maine are phenomenal.
Yeah,
super amazing.
It's a good time. I love it there. The winters are cold. It's I never realized how cold it was because you're used to it. It'd be negative 20 degrees with wind chill. And we're gonna go to high school. I'd go to high school in shorts and a t-shirt, not even thinking about it. And maybe it's also because I was a dumb teen. But the whole weather thing, it's just a different world,
Amazing.
Yeah,
as we sit here in California today, and it's it's raining, and we're freaking out because it's raining.
Yeah. No, yeah, it's the roads today. You don't even want to go out there with the folks in Southern California. I'm from Chicago, so same kind of thing, Jon. It's just a foot of snow. It doesn't even matter. You got to figure it out. You got to get to work. Here, it's a little bit of rain. Everything's getting canceled. It's crazy. So want to learn a little bit about you. How did you kind of get in the industry? How did you get started with Steady State, and then kind of maybe intro, what you guys are doing a little bit, but would love to learn about your background too.
Yeah. So, a little of my background is I fell in love in crypto and DeFi around 2019, the fall of 2019. One of my professors is a founder of a pretty big, one of the original crypto protocols built. Back in concept of the idea in 2016, 2017, I think it was, and we've been building it since. They're a 500,000 AUM or something, killing the game. 500 million AUM. And from him, I kind of learned about the space because I didn't know about compound finance and Aave, and I started researching these things, and I really blew my mind how powerful these ecosystems could actually be. And eventually, my thoughts during all of 2020 is how do I get involved, and when do I break in? And during DeFi summer, I spent a lot of time working in DAOs and crypto and doing a lot of that stuff. I started probably Year in Finance was the first project I really fell in love with. I remember when it was first launched, that was a powerful system where you could arbitrage highest yields between synthetics, Aave, and compound. And ever since then, I've just been deep down the rabbit hole trying to build and grow and be a part of the system wherever I could. The original plan for my life was go work in investment banking, go work in consulting, and then when I feel ready with enough skills, I'm going to re-enter the space and really try to contribute value. And I was actually fortunate enough to be able to enter right out of college to build Steady State, which is what we're doing right now. Yeah.
Awesome, man. Well, I want to dig into that a little bit more. You know, why you said you were fortunate enough to go straight into steady state, which congratulations. I'm so glad you didn't have to go suffer on that other side of the fence over there. And then get sucked into maybe, you know, doing what you didn't want to do. Gone through that myself. But why straight into it? Like, what enabled you to go and just start building this out the bat? Was it like, hey, I'm doing this no matter what, this is my passion? Or, you know, you were like, hey, like, you know, I made the right trade and, you know, lo and behold, now I can do this?
So an opportunity arose. So something I did during the fall of 2019 is you know, I was looking to figure out ways like that will help bring DeFi mainstream. That was one of the things. So like in their governance chats, you'll find governance chats of me proposing different ideas and financial products to build in ecosystems. If you ever find my Anon account, you never will. You know, proposing things. And from there, I actually met a company called the Yield app. Yield app wasn't launched then. They're a competitor with like Nexo and Celsius. They don't operate in the US. But I was able to find one of the co-founders in the governance chat. And basically, I was able to support them in their launch, I guess, a little bit on the portfolio side. And then afterwards, that's my last semester of college. They called me to try to build a solution to support them further, an insurance solution. So my background, actually, I have a lot of insurance exposure. I've learned from a lot of different insurance type people and learned a bunch of different systems and models. Just something I did in college, you know, and basically I never planned to do insurance also a career. It just happened to end up like, you know, they called me and said, we need help building an insurance solution and we think you can be innovative enough to try to figure something out. And from there, I did my research. I did a lot of presentations, a lot of internal conversations and meetings. And eventually I kind of started putting some things together that they really supported. And they wanted to like, we want this to be our company to be a part of this. And so as we developed and built out, you know, they eventually said, hey, what are your thoughts on going to build your own protocol? And they've been working with me to build that since then. And it's been very, very exciting and a great journey since then.
John, just to go back at one thing you mentioned, you talked about DeFi going mainstream. I'd just be curious, what does that mean to you, and what do you think that looks like?
I mean, it keeps changing for me. What you think DeFi mainstream for originally, because what I saw when I first saw DeFi was a massive derivatives market at a level of efficiency you'd never be able to realize in any institutional market. And when I remember during DeFi summer, I thought the highest proposition you could bring to institutional finance were these lending pools, okay, and different maybe a high yield fixed income type bond. Maybe I thought were the two kinds of solutions you could bring to institutional finance. And so my thoughts were, how do we construct products like that? And, you know, how does this evolve? My thoughts to bring DeFi mainstream is a lot of these people aren't going to be interacting with these products now. You know, they're going to, it's like, you think about a portfolio. Most people aren't spending their days researching stocks and equity markets, right? They hire someone to do that, or a management firm. And so I think bringing DeFi mainstream is really getting safe, strong yields, whatever that looks like, and then attracting portfolios, companies into utilizing these systems, which we're seeing now. And from there, it's about having everyone's life be impacted by that in a positive manner by seeing different returns be derived from this back-end market. And that's, I think, is how it's going to go mainstream. Is it's going to become a new kind of asset class we're going to utilize. I think the token is one of the most powerful concepts that's been constructed, okay, for business infrastructure. And I think eventually a lot of these different systems and these different tokens are going to be a key part of everyone's portfolio based on their contribution. And but I think the first step will be getting attached to everyone's portfolios, and that's going to be through portfolio tokens.
I like that a lot. That sounds, I mean, you're making it sound like it's like a passive thing. It's just kind of there. It's just kind of working, just like most people operate and work today. And that's a great response, more than you think, because like if you just look at like crypto in general across the board, that's mainstream crypto not making anyone alter their life. It's just there.
Yeah,
you know, exactly. And I find that really probably an honest and realistic answer versus saying it's a user experience problem. Maybe short term.
It is a user experience problem. But
I mean, sure. But
that's for us to worry about, not for the average person, right? It's
exactly.
When you look at I looked at this new project being built by Dot called Layer 0, and they went through a test, but I didn't realize to move from Ethereum to Binance Chain, it costs, I think it's 54 clicks. or something like that on your to move a token, a wrap token on sushi from ETH to the Binance ecosystem and while unwrapping, right, into another chain. It takes it's 50 clicks. I'm like, I never noticed taking 50 clicks, but like, how is that ever going to be a user-friendly experience? I think it's like
you're talking about a native asset,
yeah.
But however to wrap it across a bridge to the other asset was 54 total clicks.
Yeah, I didn't know that. I was just he was just labeling them, and he was able to do it in one click actually, which was pretty insane in one transaction. What they were trying to do as a test, it was 3 smart contracts in one transaction. It's crazy, but like it's like what we're seeing is like with these different things is like a lot of like no one's buying options. You know what I mean? Like no, not the average Joe's not buying options. They're not buying equities. They're not doing research on stocks. That's the clicks, right? And that's for the people active in the industry to use, and they contribute value and capital. And they see.
Yeah, no, it's a great point, and it's like, and you guys talk about moving to this passive like experience, and it's like I would say like 54 clicks. I would say a couple of months ago, like there was a 0-click option. Like you couldn't do it decentralized, right? You have to go somewhere. You had to trade it. So that's interesting. That's cool. Like we're getting 54 clicks is better than not possible, and then we'll kind of get down to like hopefully one or some sort of passive thing. But just like real life example, I mean, I went to I was helping out a friend, and they invited a bunch of friends over to like learn just a little bit about crypto. And it was like, I was like, this will be fun. Like 10, 15 people, all like different cross sections of like, types of people from different professions. And it's just so interesting, to figure out how different everyone's level of knowledge is on the industry. And then you've got the kind of like people that are super curious that are like, I want to get into it. I want to start working in it, all the way to the people who are like, I got no idea. I just hear like my daughter or son talking about this, and I think it's interesting and I want to know about it. And it's like, I think the hard part for our industry is like, how do you build for all of those people? How do you provide something? And I think it just goes back to like what you're saying of we might not be building specifically for each of those people. You just have to move it so far into the background that all of those people don't even realize that it's like being used. It's just a better option for the products that they currently use.
A great example for that is, that's what we have a lot of like, we have your intermediaries in the system, right? And these intermediaries act and they operate to help bring up the value. I know we don't like the banks, but let me bring banking up as an example, right? Like bankers are hired to look at these systems that are built and get you the best value. Whether it's a robot doing it or another person, we'll probably see something similar like that happening in this trading, this ecosystem. I had one more comment, and I think, the only way for them to like want to use a system is if the value is actually there. And I think it is. The efficiency here is undeniable. I think a great example was Mark Cuban made a tweet a couple weeks ago about trying to get an over-collateralized loan off of some of his different, I don't know, some part of his portfolio, trying to get a structured loan out of $500,000. And it was going to take him a total, I think it was said 7 days to go through the process to get this loan, or before she finds out an approval or non-approval. And he could literally just deposit all his assets on Aave. Okay. And then from those assets deposits on Aave, he was able to get $500,000, the same loan at 50%, which is what he wanted. And like, I think when you think about that as in the system, like there's probably something there where we're going to start seeing a lot of people, working with a bank and just get loan out immediately without having to go through all these systems, as long as like everything's done the back end, and the bank will be using like Aave. Or ideally, there's no banks and we're just using ourselves. But we have to be rational about what the systems look like.
Well, it sounds to me like what's going to be really important here is DeFi insurance.
Woo! Yeah, I mean, we'll see how that. We'll see how. Yeah, so I think you're absolutely right. I think what we're seeing right now is safety, and it's really important to make sure there's a lot of safety here. And when you think about how insurance works right now, it's very questionable about how good this insurance is, and currently, are they attracting the right markets? I think a great example is, how we kind of. A great example is basically one of our people or partners was trying to get a policy, and basically when they were doing research and trying to get a policy. Research on trying to get a policy for them, there were two kind of problems we found, is that these people, these business, could get a policy size for about a $50 million portfolio at that time of only $800,000 total of coverage. And so that was really small for them. And for their exposures, they needed like something larger. And they couldn't, using, looking at Shield, looking at Cover, looking at Nexus, looking at everyone, they couldn't compile more than 800K. And then the other problem they found is all that insurance was not meant for a business. It's meant for retail. If you think about how insurance right now is, you're getting your exposure to the risk of using the business, and there's no way for the business to just simply cover themselves and take care of their community. It's very odd, when Ford Motor Companies, okay, you still have to get insurance for your car if something happens that you're responsible. But when you deposit your assets, say in a bank, the bank has insurance, or when Ford has insurance, if a part breaks down, that's not your fault, and they recover that. And that's your risk from using the Ford. That's your risk from using the bank. And there is no way system right now put in place where protocols can just get insurance to cover the community. There are a few actually competitors now arriving that are starting to do that, but we're seeing a list of other problems arrive from that. One is these protocols, when you think about normal insurance, you have one large fund and you distribute policies according to the size of the fund. And you can only distribute a certain amount of value out from the fund comparative to like your exposed, like how much you can before being too exposed to one event. And so what we're seeing is they're not able to get policies. These business insurances are not able to get policies still past $100,000, $200,000. And so we're still seeing infrastructural problems here. We're starting to realize protocol insurance is definitely the future. Okay, if LunarCrush can say if anyone uses smart contracts, then they can protect their community. That's a big deal, or protect the treasury. And what we're all seeing is like protocol level insurance is definitely the future. But how we got to go by sourcing liquidity to fill these pools is we're finding is very tough if you go by the conventional insurance model. Because there's no insurance portfolio large enough to get a sizable exposure right now, because all these funds are very small.
That's really interesting with like talking about, because I could even see the competition from the yield in just regular stable coins, because at some point the insurance product has to be more valuable, or people won't have to want to move money there.
Yeah.
To say that like, hey, I'm now like it like. I for sure would buy a product if it was like, hey, you're insuring all of Algorand's and Cardano's treasury. Like, hell yeah, like give me exposure to that.
Yeah.
Because it's a more stable piece. But at the same time, if I'm like, hey, like I can still get 18.65% on Anchor with Terra, like, which one do I feel more comfortable with? It's like I feel pretty comfortable with both being this deep in the industry. So it's like now you're running into, can you be that competitive? And will Algorand, and I'm just using Algo as an example just because but will any of these layer ones or any protocols treasury, would they pay over 18%? It seems pretty expensive.
You're right. So that's the other problem, right? Is premiums versus yields. So if you're trying to source capital from a community into a fund, okay, you need to convince get yield high enough, not only just to be competitive with markets, but to be competitive compared to the risk tolerance being taken on for that. And so basically you have to think about is yield. But the problem is if you're trying to charge like an 18%, what protocol can pay 18%, let's say on a $20 million policy? No one's going to do that. That's not rational. That's not a rational business decision. You could probably get a decent coverage from the treasury if you're trying to pay that much. So there's something really dynamically problematic here where it's like the users to put capital down need high yield, and the premiums paid out has to be low enough where these protocols are actually want to pay them out, and they're naturally in competition with one another. And so maybe the question is what's the premium payment? Was our conclusion. Can we utilize the premium payment to get higher yield? And are there other ways to source yield outside of the premium payment? Was kind of my conclusions. And there's a whole list of other problems. Is how do you even source this liquidity, okay, for the risk, okay? And then that's a whole nother model we built out. But, our thoughts are, what if the token you were paid out, the dollar or whatever was paid out in the premium, could be utilized without having to pay gas fees to utilize the token? So like an asset management type deal. And the other thoughts are, what if you could convert one yield into more yields with the same dollar? And that's kind of our thoughts is maybe if you can turn $1 into multiple yields, and you can then maybe the premiums could still go down, okay, theoretically, but the yields will always stay higher than market average. And that was kind of our conclusion. We think we can do that. If you think about how an insurance fund makes money, okay, they have a certain amount of money sourced into a fund. Okay, they have a certain amount available to create payouts, but the rest of the money sourced is being put into bonds, okay, and being bought and it's growing. They take that value of the fund and whatever available to be sourced, and people get paid premiums to get exposure to that value. And so the premiums paid out, when it's paid out the fund, a large portion is then reinvested to get more bonds, okay, and growing. So every insurance fund has 3 yields, and those 3 yields are meant to keep them competitive to make sure that they're not losing money on a year-on-year basis, and they're always staying profitable and hopefully highly profitable. And that's our thought, is imagine if you take $1, okay, when it's deposited, and we reinvest and grow that dollar. That same dollar being reinvested and grown is being used to insure, and you're receiving premiums. And if you want, we can take those premiums and actually grow the value of that as well at the same time. So if you convert $1 into 3 yields, and you're able to get with that same value, there might be a way actually to be competitive while still driving down the premiums. Interesting conclusion we came to.
So sorry, I think we lost Joe there for just a moment, but we can continue. He'll probably come back here.
Yeah.
So I guess walk me through, like, how does this work? Like, what is the user journey of a protocol coming to you and wanting to be insured?
So we have 2 things. We're looking to build our own personal insurance fund, but we also have a liquidity sourcing model. So a protocol enters our ecosystem and they want insurance. Okay, if they go to any competitors right now, I go and say I want a $10 million policy. But if you go to the competitors, all the competitors say we can only do 100,000. I'm sorry, like that's all we have available for the risk we can do. What we do is we have a fund, okay, that says we'll take as much of the risk as we can, theoretically, so we get a $100,000 policy or a $200,000 policy. What we have on top of the system is what we're looking to do on top of the system is if we can't cover the rest, we're going to actually build pools where people can deposit assets to fill up the policy up to a maximum, okay, and receive the premiums associated with doing that. What we're doing then for the user journey, for the problem that the protocols have is, how do you source liquidity? Okay, and then how do you actually track liquidity in that model? And that's a whole nother problem we can get to. And then for the protocol is how do you track liquidity and how do you keep the premiums to be reasonable? And our thoughts are basically as this pool fills up to the limit that you want as a protocol and you're paying out the premiums, if the premiums are, I think it's allowing different forms of payment options as long as it attracts liquidity. So a lot of payment protocols only make payments in USDC. Our thoughts are what if we can actually take payments maybe in multiple stablecoins they can pay out, but what if we establish strike prices and they can pay out on their own token and you receive a value of token as well. And that was our kind of 2 conclusions is if stablecoin return payments and premiums are too high, what if you can pay out tokens and that could attract liquidity? What could you do then with that token? All tokens do have inherent value if they're utilized correctly. And all tokens have stake rewards. And here's like what we're doing with the protocol to control the premiums is we have our own fund, we get it. We have the separate fund where people can source liquidity to fill the pool up and they receive the premiums of whatever is owed to them. And it's going to be probably a mixture of stablecoins and the own native token of the protocol naturally being accumulated. As token decreases in value, okay, as a premium, you're accumulating way more tokens. So maybe all former yields may be lower, but you have a lot more of that token. As it increases, tokens being accumulated actually decrease, but former yields are higher. But for the user, okay, here's the problem. Okay, if you're trying to fill up a liquidity pool, even like a Nexus Mutual type pool, if an event does happen, you are going to lose all your money. And it's probably going to be way worse at a protocol level. So you think the Cream Finance hack, anyone who put money in the Cream Finance pool for Nexus Mutual got screwed. And they lost a lot of money. And so what we're looking to do maybe is rather than make one pool, we'll allow you to put money in one pool. We're building pools with fractional weight exposure to multiple pools. So if you're in a pool now, okay, you deposit into these pools. We're going to take your asset, your pool, right? We're going to take whatever dollars in collateral you want to provide to put down. And we're going to basically allow you to put in pools with maybe 1% exposure to 100 protocols. Let's say a top 100 DeFi index. If an event happens, your maximum loss in an event, let's say maybe is 1%, 2% on your principal. That same now asset is also accumulating the premiums mixture weight of 100 protocols. Of the tokens you're receiving these protocols, we're going to take them if you want and auto stake them on the protocols to get staking rewards naturally. So this adds to the model for the user. It's actually kind of powerful. Is without having to pay all the gas fees associated, as token decreases in value, at like say a daily strike price, the amount of tokens accumulated increase, which means staking rewards increase. As token increases in value, all former yields naturally decrease, but like it's as increased about all former yields are higher, but all staking rewards decrease. These are actually naturally dynamic in each other and will increase your value you receive. Of the exposure you get to all these different protocol tokens, you basically are now getting a massive exposure, similar to like an ETF that's almost yielding. But it's not. You're just buying collateral weight, and the risk you're taking on events is 1% or 2%. Of all the assets deposited in these index pools, if we accept USDC and DAI, we'll take those assets and reinvest them and grow them for you. Okay, and we're going to take those assets and grow them for you. Say we can get a very low risk rate event on a naturally well tranched portfolio we're developing. And basically, for those portfolios, say your stable coins are going at 5-6%. You're also receiving like a 5-6% in DeFi tokens of that same dollar, and you're also getting the staking rewards of every one of those tokens. Whatever the premium weight is now is no token. Now each protocol is supporting each other. All the tokens now you're receiving, like all the yields now are supporting each other. And if a payout does happen to the principal, rather than pulling your money out from what you owe, we're going to take your growth in your stable coins and cut off any loss you're naturally going to pay out. And so you're actually building a hedge naturally on a time horizon as it grows. But all these yields now, we're converting $1 into 3 yields, and all the yields are provably coming from from different sources. Usually, if you see a yield, you always have to ask the question, why is the yield so high in anything? And am I the yield? Okay, because that's a scary question there. For this system, you are not the yield. All yields are being sourced from different ecosystems naturally, and I think that's the attractiveness of the system. For protocols, what we're looking to do eventually, the problem that we have for the user is if you want to claim all these DeFi tokens, it's a gas event, okay, for every DeFi token you claim. So how do we control that, right? If you're in a protocol, even on Matic, 100 claims is pretty substantial. What we're looking to do eventually is convert those into some kind of like a token that's made up of all those things that you can actually receive and sell. If you just want to receive one token, be one gas claim event. If you don't want to receive all the tokens naturally. A great example of how this is being developed is a project called Cook Finance. What Cook Finance does is they build like coins, like kind of coins similar to like ETFs, similarly. And all it could mean is like if we established a few index pools, we could easily build something. It's now a dividend paying ETF token, where you're naturally like you can only claim one and you pay the gas fees. So you can now choose, do I want to receive all these tokens and have them auto staked for me? And then if not, I can just convert all into one and then receive that on one gas fee. And that's the optionality. So for whales, you probably want to receive every token because you want to get the price fluctuation of these tokens if you're showing this model. But for the user, if it's a retailer, if you just want exposure, you can just receive this one token. And that's what for the user journey as a model, we turn into an actually attractive liquidity sourcing model versus it's actually significantly low risk to use this ecosystem while actually buying risk, and the yield can actually become substantially high. And then for the protocols, if we source enough liquidity, as more protocols come on board the system, as long as they're whitelisted and approved by us for the first part, while we're running, then it actually gets safer for the user to use these pools. And, if you're in a pool with lower weight exposure to multiple events, as long as the pools have a good rating, then you're actually doing things very safely. There's a little more detail than that, but that's kind of what we're building.
That's a lot of detail. It's great. It's great. And I mean, on that, you say exposure and risk. Going back to the beginning, I know you gave the Cream Finance hack example way up front there. How do you look at risk? I mean, are you auditing smart contracts? Are you auditing platforms? Are you auditing processes? The team? Like, how do you go about looking at risk?
So when you look at risk, there's a lot of things there. Every protocol consensus is making a risk rating. Bankers making a risk rating. Everyone's trying to make a risk rating, and everyone's always complaining because the risk ratings are not actually working. We're still developing our actuary models, but you have to create a criteria that is provably true, and the criteria is built on what's provably true based on historical data. Okay. So for the record, if you want to create any kind of actuary analysis, you need about 3 to 5 years of data to create an output of what you think the risk is, usually for an actuary. We have I would say, DeFi has really been around since DeFi summer. I think that's true to say that we saw exponential growth that was significant during that time. And I think it's around then DeFi actually took off and risk increased dramatically. So what we do, we only have about 2 years of data. How do you create any form of analysis? Less than 2 years of data. Our thoughts and our approach is that we, first of all, we take the data and we actually just take the expected loss on a quarter-to-quarter basis, right? Just a natural output. Start manipulating the data and start looking at that. What we're going to do basically is we can start seeing what you're going to find, or what we're finding right now is we're still in this development of the risk modeling. So I'm just really showing you our process right now. We are finding truths about different things that happen that make the protocol significantly less risky. Like you're saying, audits. Who's auditing? How much auditing? And when it comes to auditing, if you want to do detail, it's lines of code audited and speed of audit. Just because a good firm that's historically good audits your company does not mean it's good if you're pushing them to read 1,000 lines of code in one day. And it means you're not going to fix the model. And so it's really looking at different kind of measures like that to actually evaluate the risk rating of the system. And the risk then also becomes two things: likeliness of event happening and expected loss of event happening. And by looking at those two, then you can create a premium accordingly. And that's kind of like how we're starting to look at things. And all the data we're looking to do on the output, we're hoping to make open source so everyone sees our ratings. A lot of people know risk rating is a very contentious system where everyone's trying to hide data because they know if they get it right, they can sell it to everyone. And our thoughts are, I think everyone hates these risk rating systems because they're not transparent. So if we can make them transparent how we're going by doing it, it allows the DAO to go by and actually keep evaluating the system. The second thing we're doing, go ahead.
Just small question on that. And it's just about the transparency of the ratings, because it feels like I agree with you, with transparency. However, as soon as any protocol knows what the ratings are and what they need to achieve to be an A rating, we live in a world now where there are just the amount of human capital that's available to manipulate any sort of rating is completely there. Yeah. So it's how do you find that balance between if you said, hey, a protocol in order to be, one of the KPIs is 500,000 addresses, or a community size of 100,000 posts a day on on social or something. These folks can go get that, right? Yeah. And anyone can go get that, versus saying, and we kind of deal with this too a little bit with because we're kind of providing some sort of rating, right? And it's we're constantly, it's it's a battle at all times to stay ahead of where the other parties are at, because they're going to never stop. And so it's what do you think about that a little bit, where it's some stuff needs to be transparent, but some stuff needs to be the secret sauce of why you're providing the best rating?
Yeah. So two things. First of all, you're right. So banks, okay, they keep certain credit risk ratings private, because if you get to hit certain criteria, you could try to manipulate it, and it's not necessarily good to manipulate. You take something like a parametric model, or different kinds of models where it's open source criteria. If it can be manipulated, then you're not going to be able to do it. Now, let's say historically, though, we know if you have certain audits from these companies and you take exponential amount of time per line of code, this has actually never been hacked, these systems, okay, but by these people. We can post that and make that a criteria. This is a standard we should be trying to achieve, and or if you're backed by different ecosystems, this is a standard that you're trying to achieve from there. Mm-hmm. So that's one thought, is that's not necessarily a bad thing. Now but the thing is you're right. If you have something like wallet addresses, if you have something community members, and you just have to have XYZ amount, you can just pay for that, or you can just do it yourself. And so it's also how much you value, and certain things you can get that it can be provably very true are not easy to get, even if you know. And the things that are, you can get, but you just have to weigh those significantly less than before. And that's the really important thing. It's you can definitely get a triple C, but are you going to get a triple A? Is that what you're saying? And these triple A's, you can't just bake an audit from this firm. Okay. Provable exposure. Let's say if LunarCrush had an auditing company or auditing project, you can't fake having LunarCrush looking at that, right? Looking at the backend code. Open sourceness. You can't fake being open source. And also there's other thing to add is there are a lot of code structures available that you can know are usually malicious. A honeypot has a very, very direct code structure. Money goes in, money can't come out, and you get token, but money is not coming out, and we don't know the value of token. That's a honeypot, and we can always look for criteria like that as well. So it's it's in one breath, it's treating standardization where you should be trying to achieve these, and if you don't, it's also make sure the criteria cannot just be naturally hit and easy. That's our two kind of thoughts and approaches. And it also, it's not a bad thing for everyone to be using your risk rating system. And that's my honest thought. It's especially if you're trying to work more like, we're not a normal insurance. We're in some ways we're a product. And because of that, you have to it's not a bad thing to push people towards better behavior. And knowing from these state, you get better behavior. It's just making sure it's not a copy and paste, like you're saying, like wallet addresses and stuff.
Mm-hmm.
The better behavior part is extremely important. There's a lot of, I don't want to call them bad actors, but there's a lot of people that take advantage of every system here. This is sort of the ground floor of like yield farming. Like I'm always going to take advantage of what always is ever there. And it doesn't matter what's ethical or not. I just got a higher yield. Yeah. And it's like, it makes me wonder, like, as part of that, like as an example, could launch a token today on BSC and bridge it over to Avalanche and all these other chains in the next few hours, right? It's a token that doesn't, it could be a token that does nothing, right? It could just be like I might have a lot of money and I have a utility list token. I'm throwing it out everywhere. It's everywhere. It does nothing, but it offers really high yield. Yeah. Like I'm looking at there's a lot of that, by the way, out there. And I look at like risk from that standpoint of like, hey, they might check all the boxes. The code might be pretty good. Everything looks fine. Looks like there's a legitimate team. Doesn't do anything though. This token's just a cash grab. Like there's a lot of that. And so I wonder, like from a risk perspective, when you look at insuring things, how does that play into the mix, the utility part?
So when it comes to like things, that's not there's no clear, concise answer there. Because if you're fully decentralized, right, you're going to necessarily maybe have problems where these guys can break in. And they can build a fractional pool, or they can join a fractional pool and then get all these different things in. Our thoughts on that is, at least in the first model, we're gonna have to whitelist to make sure we approve every good protocol that comes in. We just have to whitelist it. We have to. It's just the reality. And our thoughts are we can probably borrow a lot of the models from Rory Capital and the whitelisted yield models from like Rory Capital and how they do things. They have the whitelisted pools and the non-whitelisted. You can use the non-whitelisted if you want, but like our thoughts are, if we don't approve, okay, just because of the system, like, say if we wait length of time is also a thing we try to get insured. Let's say that, and they don't meet that length of time criteria, then let's say, because they're obviously, if they're a money grab, the project's not going to last that long. And, unless you consider Ohm, I don't really consider like an Ohm to be like a money grab, but the Ohm forks potentially, right? So like when you look at those systems, I think it's just like saying like we have to whitelist to make sure we know these are long-term projects or long-term protocols, and they're also, so not just because the code is good, make sure it's a long-term project. And I think that's really important for how you're going to go by evaluating these things. That's kind of my thoughts. And it's just a whitelist. I think we're going to accrue criteria where if we approve it and we think it's a good system and we do think it's a long-term project, we're going to allow them to join these fractional pools. If people want to deposit money in these risky pools on their own, maybe you can promise 10,000 APY. I don't care. You know what I mean? If people are going to put money, they're going to put money in. But like, we're not going to let them join these like attractive liquidity systems, if they're not whitelisted. And that's our thoughts. And whitelisting can be somewhat decentralized, where it's run by a DAO. And I think Rory's doing a good job achieving that.
And so like as some of these protocols are insured, let's say that they're insured, but then they get on some exchange, and that exchange gets hacked, and that exchange just lost 1 million of their tokens. Is that exchange now responsible for that? And is like the responsibility of what you're insuring, is that off limits now, or is there like a line in the sand?
So we'll make it very clear. We're covering your smart contract risk, and if you're an investment or like an investment vehicle, like you're in finance, we're going to help try to cover a weight of your exposure to all the other vehicles you use on a smart contract. On the lines of going on exchange, no, probably not. No, I don't think you can really cover that, because like if we can't audit the code, if we can't look at the system, we can't prove it's good, then how do you cover that? And that's the reality there. Is like you can't. And I think a great example is like everyone's getting really upset about the recent hack on GPTC, and if I'm trying to remember the name of the protocol on top of my head, but it's like a OG Classic, GPDC. There was a major hack on the front end recently where someone manipulated the wallet address that Bitcoin was being moved to and stole a lot of money. And, on the front end, but and people are mad, no one's insured for that. But the fact that the front end is closed source, is quiet, and no one can see the code, it's very hard to, how do you go by and actually say, I can insure that if I can't prove anything about the system? And that'd probably be the same for exchanges. We can't prove the security of a system. It's not open source. It's not doing that. So we can't cover that. What we can cover is your exposure to other open source systems and the open sourceness about that. And I think you can also cover your own open sources, your own smart contracts is what we can protect.
It's a really exciting and interesting delineation that you just said, because
right,
I think people look at DeFi and decentralization as scary and there's more risk. And technically what you just said was actually the central entities are very risky because they also don't have proper insurance either.
Yeah.
And they get hacked and they can't be audited properly, nor can they be insured properly.
Yeah, exactly. So it's you're right. You said it. So it's if you don't know what the technical risk is, how do you insure that? And that's the real problem here. And in these open source systems, we can evaluate, we can grow, and we can build together. And we're going to see that happen, I think, as we keep developing and grow. One problem is, part of these codes are being built by mad geniuses, and those rarely ever get hacked. And the ones that aren't are being made by high school kids. And I think, was it Temple DAO? I saw a joke that Temple DAO, the CEO of Temple DAO, is dropping out of high school to manage a $50 million treasury. Was a joke. But
I kind of love that. That's pretty funny.
Yeah, right.
hopefully we're throwing fuel on the fire and that kid's like, screw you guys, I'm going to build the shit out of this.
Love it.
Yeah. So, I mean, we're in a weird place right now. But these open source systems are something you can evaluate and we can build around that together. We can create standardization, what to look for. A project I always like to point out is Credmark. Credmark is one of someone we're partnered with. We're going to be working very closely with as we build this risk system out. They're trying to be the Moody's, basically, of DeFi and try to be an open source, decentralized Moody. And because of that, what I love about what they're doing is they start pushing standardization of what to be approaching and trying to be. Okay, and the actual value of products being built, but the standardization aspect is really important to me because now we have something to work towards. We know if you do this structure, you're fine. If you get these codes, again, what we're saying, the likeness of bugs are much lower, and the other systems being built as well. SteadyState.Finance is a really cool project where they're basically conglomerating where to do white hacker, what's it called? White hat protection,
white hat hacking,
bugs and bounties, and there's another project I know personally, a guy doing something similar with the graph to build nodes and to find all the lists. So what we're seeing is standardization and good behavior working together to build systems, and it's just creating good incentives to keep doing that. And I think we're on track. It's just going to take a long time, but I think we're going to approach a point where using DeFi is safer and less risky than going to be using a lot of these exchanges. We're going to approach it.
I love that John asked you kind of John asked Jon Libby, which is an actuarial type question. And your actuarial type answer was, looking at assessing the risk of these two things, the decentralized one is provable, right? And we can see that. And so, there's the human element to a lot of this stuff, right? It's all these hacks that happen. It's like the Twitter hack. Right. It wasn't someone actually going and hacking the code of that or breaking a password, a brute force entry. That stuff doesn't happen as much as, hey, we're kind of social engineering, figuring out someone that works there. That person had some sort of leak, right? Because we're all humans, and that person had a family or a dinner to go to or something. There was some moment of weakness somewhere, and that's the person that ends up, kind of getting hacked. And it's in the centralized system. That's all over the place. Yeah. There are leaks everywhere, and it's so randomized that it's because it's just humans and it's human behavior versus saying, hey, this is the code base, right? We can prove that this is how it works, right? These are the only people that can call this smart contract. You can ensure that. Yeah. Right. It's it's very in the, and it's in the traditional world. And it's if you've got the large insurance providers, insuring the Coinbases of the world and everyone else, Like, look, yeah, as soon as something happens, they write that out. They write that out. They write that out. Like, they're writing everything out instantly as soon as like a new kind of threat comes, and then you got to pay for it. And then how expensive does that get? And so it's like that's why you ultimately see a lot of these people self-insuring.
Yep.
Right. Because they're like, hey, I'm going to go start self-insuring, once I hit a certain critical mass. I mean, is that an opportunity for folks that, like, for you guys saying like, hey, we're just going to press this button here, self-insure this? Like, we're just kind of like this underlying technology that's going to kind of support that.
Ideally, okay, the captive model, right? That's called captive insurance when you choose to self-insure. We'd love to be a model like that long term for the protocols. So our thoughts is, first of all, ideally we direct with the treasuries. Okay, we direct with the protocols, and so if the protocol gets hacked, right, we give the money to them and they distribute accordingly how they need to. And maybe down the road we can create a media where we just directly work with the user through the protocol. We just like do the launch. But so what you're saying, yeah, I think the problem with self-insuring is, can you get a policy sizable enough to create the maximum coverage you need? And secondly, can you find other different kinds of alternative entities that'll help build out your model, like reinsurance? And so I'm hoping what we can be eventually is a model where protocols can, like, especially that are growing out, can put like an insure button. Okay, like you're saying, like on the protocols, you get a lower yield. That yield just goes directly to us to pay off to build a larger fund. That gets more protection for the user. And that's what I'm hoping we can be. And eventually, if there's enough trust in certain protocols and certain DAOs, then we can just build captive, right? You can build a captive fund or captive fractional pools where protocols deliberate, but we create a risk report, we submit it, and the protocols deliberate accordingly how they need to distribute. And like that'd be the long-term vision, if something like that. It's just making sure we have a good claims process right now that's put in place that's going to be fair and balanced, and which we're still designing, but it's fair and balanced and something that isn't like creates bias or bad actor behavior. I see a lot of claim systems being built that have been practiced in the system that incentivize people to not create payouts even if the event happened, where if it's been both on a mutual voting or something, and like because if they vote, they lose their money on the pool. Like yes, if they vote no, they don't lose money in the pool, and like there's a lot of bad actor events that can be created from a lot of systems being built out. And so our goal is to like try to make it as unbiased as possible. But the problem with a captive fund is it can become very biased as long as they're not violating their policies too much. And so that'll be like a next step. We'll have to worry about that now.
So question on a claim event, how do you know that you're not being gamed when someone says, hey, we were just hacked for $90 million? And I mean, there's a couple things, like what if they're the bad actor trying to game you? And then what if they were, or what if they're, I don't know, they were all at the Dubai Formula One race, their CTO that hold the private keys, and someone hacked them. They weren't paying any attention. They were negligent.
Yeah.
And like, so how do you look at an event and distributing claims?
Man, those shadowy supercoders, man, they're always putting bugs in the
right.
So that's a tough one, right? So it's whose job is it to deliberate? Our kind of goal is to basically create risk reports. After the event claim is filed, we create a risk report from this database we're building and from other databases. And we're going to submit it to an unbiased court on what we think the event was, and like the suggestion, probably like an Aragon court, or to basically deliberate and be like, here's our report, here's our expectation, here's what we think you should do. And they create a payout accordingly. Ideally, postmortems come out later. We can look at that and evaluate. But that's proven to be not clear. We have to do our best to deliberate and make sure the protocols we bring on board are solid protocols, and that comes down to the whitelisting process. And secondly, you have to try to do our best to try to deliberate the reports. Postmortems don't always do the best job of figuring out if it was internal or not. Sometimes they do, sometimes they don't. And our goal is to create our own thoughts on what it was in the event and have an unbiased group has to vote on it. And we think that's the best way to do it. What we need to make sure is controlled loss. Okay, if we do a model like that for the user, okay, the less control you have over your underlying assets or principal, it gets kind of scary. So for you, as a user, as a capital provider, when the event's happening, you don't want to see loss on your initial principal, whatever the weight is, especially in events that you don't agree with. And so my thoughts is, if we can convert a high enough yield and we can fractionalize the weight, we should be able to hedge off any loss you're seeing. And that's the point of the fractional pools coming out again. Is your loss is very controlled, so hopefully eventually it'll be not noticeable. It's kind of our vision is how we build these pools out over time.
It's great.
What ends up happening there too is, your incentive, ends up becoming like security and safety of these assets, right? So you become like the best educator on, the best practices for like handling these kind of large sums of treasuries or whatever, like whatever anyone wants to be insured in the space. So it's like you end up becoming the people that are like, hey, we do need to solve some of these UX issues and some of these safety issues for some of these things. And like, how does that work and how does that look? That's an interesting incentive model because it is more profitable for you guys to not have to pay out these claims, right?
Yeah.
And that, I mean, it is interesting with, when you say an unbiased panel of folks, right? It's like, what does that end up? Because in my mind, it's kind of interesting if you're like, hey, what if there are like the top 10 DAOs out there, right? It's like Pleasure DAO or like whatever DAO that ended up being kind of created. It's like, what if you could say, hey, these DAOs have some sort of rating, and because you said it's like almost like a court system, right? But we're saying now we have this like decentralized court system of DAOs, and like some of the people in these DAOs are like, a duck avatar, but like they have a very high like competency rating because maybe they have a million ETH or whatever it may be. It's like that becomes super interesting, but it's like, how do you decide what that panel looks like and who the people are that have like how like educated are they on the industry and that specific case? So it's like you almost need like legislation for crypto in a way.
Yeah, no, you're exactly right, because if you have a bunch of randos, no matter the report you build out, if they don't know anything, it's not a good idea to have them vote. Our thoughts are we can produce our eventually vision is to produce some kind of risk analyzer or underwriter to create reports, and basically as the size of hack goes up, the more required to discuss and deliberate with this core system, the more you have to have basically of deliberators to help educate. So, say the hack goes to like half a million, you need 2. Okay, if it's $1 million plus, you need like 4. And these guys are meant to work in this court. And secondly, we also, when people are added to the court, we have to make sure they're verified to be able to deliberate both unbiasedly, and we think are competent enough to get the knowledge there. So what happens, I think, is if you pick a random selector, you still have to do due diligence after the people are randomly selected, and you have to figure that accordingly. And then that'll probably come down to the underwriters to make sure, like, I think this person, just simple questions. I think this person can deliberate. Ideally, eventually it'd be good. You select a few DAOs and you have a couple like members from each DAO, or a couple members like from each DAO. Maybe you have a list, right? You just pull from the list and randomly select from the list, and then this person has a bias, this person has a bias, this person has a bias, and you do that. There's no system right now that does that, and it's tough to do that internally. And so, ideally, we've definitely talked about that, especially with the own internal fund, is let the DAOs argue with each other about if it's their buddy. Was the joke, and because then they create their own standards. But like, ideally, we want to work to something like that, but we just have to make sure we're being both responsible. So make sure we produce the right underwriters to keep reporting, and secondly, we have to use the technology we have now, and we think that's still the best way, unless you want us to do all the deliberation ourselves, and that might not go over well, as we've seen with other systems.
Yeah, this is such an interesting conversation. I actually want us to sit here 1 year from now and see 1 year from today. We should put it on our calendar and see how this has evolved, because this is like, people, they throw the word governance around, right?
Yeah.
And people are trying to figure out, well, what's a governance process for letting your users vote on things, right? They're thinking simple things. They're not thinking of like letting a like very defined architecture of users who are going to vote on a $90 million hack that occurred and what should happen and evaluate all this stuff. Like, that is next level governance.
That's a lot of pressure, right?
It is. And then you have like, different domestic laws. And because like, let's say, some of these protocols are a corporation in a country, right? Like, is this legally recognized by any court system? Is it not? Or is someone opting out of that system by getting, DeFi insurance over here versus saying, I'm going to insure with, say, Aon or something? Like, is it a totally different structure? So there's so many rules to figure out with this.
Well, think about it too. It's like, where did the hack happen? Right. Well, it happened on a protocol.
Right.
Maybe it didn't even happen like on a cloud computing system. Like it didn't it happened somewhere else. It's like, well, what jurisdiction is that in? And it's like, well, what if like 6 layer ones all had something happen? It's like, do each of those like governance protocols or foundations like elect a person to go talk about this? And then like, what jurisdiction is that in? And like, what does Germany have to say about that versus France versus the United States? Like, who's in charge there? Or are we just creating this new system where it's like, because when you think about it, we're talking about creating like some sort of Supreme Court is what we're saying, like a board that's going to decide. You were talking, John, you're like, they need to be duly elected or duly, like it's the same process where we're like, hey, is this person good at this? Right. Yes or no? And we have a person that we've elected that says that. What we're saying is, how does that happen in a decentralized open manner where people can vote? And then like, which protocols maybe, because what you're saying is, hey, maybe Stacks has an A+++ like governance and foundation, and we've all agreed does like their vote count more than maybe another protocol that's not as much. It's like, holy shit, we're basically rewriting everything right now. And we've got, and it's just interesting because it all comes up with insurance, because that's where there's actual like what happens here, right? With everything else, it's like there's never as much of a conflict. With insurance, it's like someone wins, someone loses, and so someone has to decide that.
The long-term vision for Steady State is to move away. Yeah, it's how far do we want to develop that system, and is that the best system? We also have to ask. Okay, so for the policies, one system I really love. I came to a lot of the same conclusions, and I think they came to it before I did. But like I came to a lot of the same conclusions a lot of the time they made theirs publicly about like with Risk Harbor. I love their system. It's a parametric automated insurance payouts. The problem, parametric is a form of insurance where as long as you can prove like on public transparent data, if an event happens, you agree to a payout pre to the event, what the payout is, okay, and the criteria is, and you also agree the payout happens based on parameters hitting, and parameters that can't be manipulated. So like the example is like a hurricane or an earthquake. You can't manipulate that much in damages to a city. You can't manipulate a Richter scale. You can't, you know what I mean? The numbers are the numbers, and it's public and transparent. You agree to. You can't like rig the fact that your business collapsed from it. You could try, but that's a lot of work.
Yeah.
It's like and so like it's parametric automated data where you agree if triggers criteria is hit, then organize the payout. My goal is for us to almost move to that system over time. But it's how do you get there? It's like Risk Harbor again. I think it's a good system. They're probably asking the same question because they want to do smart contract protection at the retail level, but right now they're only doing depeggings because depeggings you can't really manipulate that. It depegs or it doesn't, and so it's like if it turns out that automated policies are just totally not viable, then we just think we go as far into this other system as possible and build it out to as robust as we can, and we'll see what that looks like. I think first our worry about is make sure we have market fit, which is what we're doing right now in the product documentation, and then build product right. Like we're like 45% built out, so we want to make sure that everyone's on board for the build and all the protocols we have on board for the project so far are on board. And after that, we worry about everything else later.
On that note, what can the community look forward to coming soon from Steady State?
Right now we're deep in the weeds of product documentation. So making sure everything makes technical sense. And from there, we'll be looking to do, we have a lot of protocols and projects on board already that are really interested in what we're doing. And so the goal is to make sure, do some test routes with them to make sure everyone's on board with all the builds and the UX UI is friendly. So that's what we're doing all internally for the next couple months, like next month, I think we'll be doing. And then after that, we're going to do a seed round. And then after that, we're going to finalize that. And we're going to do product launch. Ideally, we'll have the actual date soon from the CTO, but we're looking to have a testnet and product launch around March, April. And what I want the user to see, basically, when we have this out, this testnet, is I want you, the user, to see high yields. I want your experience as a user to look forward to. It's not, oh, great, another insurance protocol, but actually a different kind of model where the risk is low and the returns are high. And the returns may all be variable, but they're all coming from somewhere. And a new product where you're accumulating a bunch of tokens, naturally, you don't have to worry about which ones you're going to buy. And one freaking increases in price like crazy, you're like, oh, wow, I already have that. Release, dashboard, pay. So I can do what you want. A new system where you get mass exposure to DeFi in very low risk actually by ironically buying the risk.
It's very exciting. Very cool.
Awesome, man. Well, John, you're gonna have to end the broadcast because I'm on my phone and I have 1% left. But Jon Libby, man, hey, dude, super fun, learning about you and insurance and John and I always go down the rabbit hole. I feel like if it's like nonprofit insurance, all like the things that people think are boring are not at all, and they bring out all of the best pieces that like the real problem solving. And it seems like you're gonna go down that path with yourself. So best of luck. Come on in a year. Let's talk about it again. Let's see where you guys are at. But really appreciate you being on here, and thank you everyone out there for listening to this. And it'll be on all the podcast networks and everything else. YouTube, it'll be up tomorrow. So appreciate it, man. Thank you so much.
Great. Take care, everyone.